Hey everyone, so I'm a long-term investor who invests most of my money into ETFs. So then I can dollar cost average my investments without spending too much time thinking about when I'm going to buy and when I'm going to sell. And I can also take advantage of compound interest. However, I also do like to invest in individual stocks and businesses which I really understand and businesses that I really believe in, because I believe that this can give me even better returns and even greater growth. But with the potential for better returns also comes greater risk. So before I invest in any individual stock, I do my research on them first. And in this video, I'll go through, or should I say, we'll go through, what we look for in an individual stock before we invest in them. I'm super excited to announce that Tom from the Investing with Tom YouTube channel is also joining us in this video. So he'll also be sharing some things that he looks for in individual stocks before he invests with them as well. Tom is from New Zealand and he has some really awesome content on his channel around value investing and how to make better investments by following the methods of some of the biggest and best investors in the world, like Warren Buffett. So if you like learning about how to make better investment decisions, I've left a link down in the description below so you can check out Tom's channel. He has some really great informative content, so I think you'll find a lot of value from it. So now let's throw it over to Tom to give us the first thing that we look for in an individual stock before investing in it.
Thank you, Queenie, for having me on the channel. Now, the first thing I look for when purchasing a stock is firstly thinking back to what a stock actually is, because that frankly is going to inform a large percentage of how we think about making an investment. Now, shares in a company, shares that trade publicly in the stock market, are simply a small slice of ownership in that underlying business. So in order to make a confident investment in that business, we should think about it just like we would purchasing a property down the road, buying a local laundromat, buying any other type of business. The fact that it trades publicly and you can buy it and sell it really quickly shouldn't really change how we think about it as long-term investors. So with that said, if you're looking to make an investment in an individual company, you should really understand that business inside out. Understand it just as well as you would understand that rental property down the street. If you're looking to purchase into a business like Apple, for example, you should look at how Apple makes their money. You can read through their annual reports, listen to their conference calls, learn as much as you can about the business, and you'll see that they make money from selling devices, whether that's iPhones or MacBooks or iPads or whatever it is. They also make money from service revenue, so things like the iCloud, like Apple Music, several other services that Apple have, and you can really start to get a feel for where the future trajectory of the business is heading. Is the business likely to grow? Is it likely to shrink? What factors are going to influence the success or lack thereof of that company? Because as we get later down this list of what to look for in an individual stock, we're going to talk about valuation. What is the business actually worth? And a huge part of valuation is all about what does the future look like for the business. So if you don't understand it, you can't do that step. And that is why understanding the company is the most vital step before making an investment in an individual stock.
Thanks so much for sharing, Tom. I think it's so important to switch your mindset from owning a stock to actually owning a business. And this brings me to the second thing that we should be looking for in an individual stock or business before investing in them, and that is the economic moat, also known as the competitive advantage. An economic moat is a distinct advantage which allows a company to really thrive and protect its market share and profitability from potential competitors. And it is often something which is really difficult to mimic. So it essentially creates a barrier against the competition. So personally, I like to invest in companies which I believe have a really strong moat and a really distinct advantage against their competitors. And I also like to invest in companies which have really strong financial performance and growth over the past 10 years, because this shows me that the company has been operating for a long time and it is thriving. And so they will probably continue to thrive and survive over the long term. And by the way, if you're enjoying this video so far, make sure you give this video a like and turn that button blue. Can we get to 200 likes on this video? I think we can with your help, so make sure you give this video a like. So now let's throw it back to Tom to give us the third thing to look for in an individual stock before investing.
Tip number 3 for what to look for in an individual company is to really understand the management, understand the CEO, the board of directors, who is actually running this company, and what is their vision for the future and how they're actually managing the business today. Now, there are two main things that I look at which are actually quite quantitative for assessing the management of a business. Many people think that judging the management team and understanding how well they're performing is quite qualitative, kind of soft and fluffy kind of thing to look at, but we can actually put some pretty hard numbers behind the success of that management team. Now, there are two main areas that I look at. The first one is some metrics called return on equity and return on invested capital. This basically tells us of all the equity or the equity plus the debt within the company, what sort of return are the management team making on that business. If we have, say, $1 million of equity in that company and they are earning $100,000 on that equity, that tells us that they are making a 10% return on the capital that we have in that business. And that is a very, very important metric for the long-term growth of our investment. If those managers are only making a 1 or 2 or 3% return on equity and return on invested capital, that tells us that perhaps the management team aren't performing as well as they potentially could. And if you look at an absolutely stellar business with a phenomenal management team that's cranking out 15 or 20 or 30% a year return on invested capital, you know that your money is probably in pretty safe hands and can grow at quite handsome rates out into the future. The next important thing I look at with a management team is how they manage debt. Now, debt is one of the few things that can absolutely destroy an investment altogether. It can take your investment from whatever amount of dollars you put in all the way down to zero. Debt can absolutely kill a company. So it is very important to keep an eye on, and it's important to understand how the management team thinks about debt. So one of the places that I like to look is the balance sheet of the company. This shows us the assets versus the liabilities within that business. And what we want to look for is the long-term history of debt. Has it grown over time? Has it shrunk over time? Is there none at all? That would be fantastic. And we really want to understand what is happening on that balance sheet and potentially the reasons why debt might be going up or down. If you take a business like Thor Industries, for example, they are a company that manufacture both motorhomes and caravans, RVs and trailers as they call them in the States, and have done for a very, very long time. Now, traditionally Thor Industries has had a very conservative management team in terms of how they take on debt. Typically, they have basically no debt. But a couple of years ago, that management team made a very large acquisition. They actually bought another RV manufacturer by the name of the Untitled Group, and in order to do that, they had to take on quite a substantial amount of debt. Now, it's been really interesting to see how that business has managed that debt load, and basically what they've done is they've tried to pay it off as fast as humanly possible, and that's a fantastic thing in order to protect the downside for investors in Thor Industries. So those are a couple of the key things that I look for with the management team. How's the return on equity and return on invested capital performing, and how are they managing the debt, because that can potentially wipe you out as a shareholder. So I'll pass it back to Queenie for tip number 4.
Thanks for that, Tom. I think it is so important to look into the management team before making an investment, because these are the people that you're essentially giving your money to. So you want to make sure that they have the company's best interests at heart. So the fourth thing that you want to look for in an individual business is really strong financial performance. And by this I mean good revenue, good operating income, net income, operating cash flow, and free cash flow. Ideally, we want all of these numbers to be positive and also going up year on year. Another metric that I do like to look at is the return on invested capital, which ideally should be at least 10% per year for my investments. The return on invested capital gives a sense of how well the business uses its capital to grow its revenue. So now let's give it back to Tom to give us the final thing to look for in an individual company before investing.
Thank you, Queenie. Now, the fifth and final part of this video is talking all about valuation. Now, if you've found a stock that ticks all of the boxes of the previous points that we've gone through, right from understanding the business all the way through the management team and the financials and so on, the last thing to check is that before you buy shares in the company, you're paying an attractive valuation for that business. It's important to understand that just buying a great business is not all you have to do. You actually have to buy a business that is really high quality, but also you have to get it at an attractive price. If you pay too much for a stock, it's quite easy to actually turn a great business into a poor investment. Let's take the example of a company like Microsoft. Now, if we go right back to the year 2000 and look at the company Microsoft, people were really excited about this business. They could see that it was probably going to grow a massive amount out into the future, but unfortunately we were right in the middle of the tech bubble and people were paying massive prices for Microsoft among many other stocks. Now, from that point, investors were actually correct on how well the business would perform. The business continued to grow and grow and grow, and Microsoft is a company that is still growing today, but they did not get the valuation right. If you had purchased Microsoft in the peak of the dot-com bubble in 2000, you would have had to wait till 2016 until you broke even on that investment. So price is very important, and we have to make sure that we are paying an appropriate valuation when we purchase into any company, regardless of how high quality it might be. Now, there are many different ways that you can assess the intrinsic value of a company, a valuation for the business, which is often distinctly different from the market price at any given point in time. We can look at doing things like discounted cash flows, Phil Town's margin of safety analysis, a 10 cap analysis, and there's plenty of videos on YouTube, both on my channel and several other channels, on how to go through that process. But for this video, I want to explain the reason why you would search for a margin of safety in the first place. This idea of purchasing into a stock for substantially less than the intrinsic business value of that company. Now, purchasing with a margin of safety achieves two main things. Basically, if we buy $1 of intrinsic business value for, say, 50 cents, we create a lot of potential upside for ourselves, and we also create quite a lot of downside protection. Now, if we're right on the company and we can purchase $1 value for a price of 50 cents, and that 50 cents goes back up to $1, let's say that takes about 3 years, we've doubled our money in 3 years, and that comes out at about a 26% return over that period of time. A very high return. And the other thing that does is, if the business doesn't actually perform quite as well as we might have first hoped, we've got a lot of downside protection from purchasing it with a really low price. For example, if we think the business is worth $100 and we buy it for 50, and then the business doesn't grow anywhere near as quickly as we first might have thought, and the intrinsic business value goes down to 70, we've still managed to pick up the business at a price far below the intrinsic value, and it protects us from a lot of permanent loss of capital and downside in that investment. So that is all from me. Thank you very much to Queenie for having me on your channel. I really do appreciate it. I'll now hand everyone back to Queenie for an outro.
Thank you so much for your last tip, Tom. It was so great having you on the channel, and make sure that you do subscribe to Tom's channel. I've put a link down in the description below so you can check it out. And thank you so much for watching this video. I hope you enjoyed it and found some value out of it. If you did like this video, make sure you give this video a thumbs up and write me and Tom a comment down in the comments below. We would love to hear from you. So I'll see you in the next one. Bye! And I've also done a video on Tom's channel which you can check out here with the links, and I've also put another link to a video here so you can click through. So make sure you click the links.